Welcome back, my friends. Brace for the intense pressure on commercial real estate to spread to house prices, Elon Musk says. Commercial real estate is melting down fast. Home values next, the tech billionaire tweeted. Investors are worried about real estate in a period of higher interest rates and tighter lending. Commercial real estate is in trouble. A banking crisis will make it worse. You have all heard of the many abandoned shopping malls across the country. And, if you follow this channel, you know of the retail ice age. And you have all probably driven past strip malls with many empty stores. Maybe you have heard of the soaring office vacancy rates in San Francisco and Los Angeles. And the defaults on mortgages on skyscrapers. Well, it looks like commercial real estate is the next shoe to drop. What does this mean for the real estate industry? What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. And, before we continue, a word from the sponsor of this video. Today's sponsor is InnerLife.com, creator of the InnerLife STS system. InnerLife STS is a cloud mobile platform for mental health care and its integration with primary medical care. InnerLife STS is designed for assessment, data collection and analytics, documentation, and progress tracking. InnerLife STS creates and composes conceptualized narratives and builds them into professional-grade reports. These reports are designed for use by mental health professionals, primary care physicians, justice system professionals and universities and include mental health assessment reports, mental health treatment reports, and treatment progress reports. And InnerLife STS uses doctor-selected pseudonames for all patients. So, only the doctor knows the patient identity. Elon Musk warns house prices are set to plunge, and says commercial real estate is in meltdown. Elon Musk is once again ringing the alarm on the U.S. real estate sector. Commercial real estate is melting down fast. Home values next, the Tesla and SpaceX chief tweeted on Monday. The tech billionaire made the comment in response to a tweet by the Kraft Ventures founder David Sacks, who said that a big chunk of commercial real estate debt was due to mature soon. Musk has previously warned that cracks could appear in property markets following turmoil in the banking sector. For example, the clean energy pioneer said commercial real estate was by far the most serious looming issue, and cautioned regional banks could experience a wave of defaults because of their huge exposure to the sector. The debt-fueled industry has kept investors on edge in recent months, given that it faces a raft of headwinds. These include higher interest rates, tighter credit conditions, and work-from-home trends. J.P. Morgan estimated that about $450 billion in commercial real estate debt set to expire this year could default. Meanwhile, Morgan Stanley Wealth Management said commercial property prices could tumble 40% from their peak in light of the sector's troubles. The U.S. housing market is also dealing with similar problems, which likely explains Musk's view that prices were set to topple. Morgan Stanley reported that home sales have bottomed as higher borrowing costs crippled demand, with experts warning of a potential 15% to 20% plunge in prices. In response to historic inflation, the Federal Reserve has hiked rates from virtually zero to upwards of 5% since last spring. While the pace of price increases has slowed, the painful combination of higher borrowing costs and steeper prices threatens to weigh on demand and economic growth. Moreover, lenders are pulling back in preparation for further bank runs after a wave of deposit withdrawals toppled Silicon Valley Bank and Signature Bank in March. Those forces are putting downward pressure on asset prices, fanning fears that the prices of houses and commercial spaces could suffer. If there is anything commercial real estate owners don't need right now, it's a banking crisis. Big owners of property around the country are under pressure from the Federal Reserve's aggressive campaign to raise interest rates. Rising interest rates have raised borrowing costs and lowered building values. These institutional property owners also had lots of space still sitting empty in city centers as a result of more hybrid and remote work arrangements resulting from the pandemic. Now they face the prospect that beleaguered banks, especially smaller ones, could get more aggressive with lending arrangements. This gives the big landlords even less room to breathe as they try to refinance a mountain of loans coming due. This year, roughly $270 billion in commercial mortgages held by banks are set to expire. And $1.4 trillion over the next 5 years. Most of the banks that hold commercial real estate mortgages are small to mid-sized institutions that are experiencing the most pressure during the current crisis. This began this month with the high-profile failures of regional lenders Silicon Valley Bank and Signature Bank. The pressure on regional banks continued Friday, stoked by intensifying investor pressure on German lender Deutsche Bank as the cost to insure against default on its debt soared. Smaller banks began ramping up their exposure to commercial real estate in the aftermath of the 2008 financial crisis. For those of you who remember, the 2008 financial crisis was triggered by a housing bust. Smaller banks stuck with it even after the pandemic emptied out many city center properties and other forms of borrowing provided by commercial mortgage-backed securities and life insurers dried up. Signature was among the banks that made some of these bets. It was an aggressive lender in New York City to office towers and multifamily properties. By the end of 2022, it had amassed nearly $36 billion in commercial real estate loans, half of which were to apartments. That portfolio comprised nearly one-third of its $110 billion in assets. More than 80% of all commercial real estate loans are now held by banks with fewer than $250 billion in assets. These loans now comprise the highest percentage of industry loan portfolios in 13 years. There's a lot of commercial real estate that's been financed over the last few years, said BlackRock Global Fixed Income CIO Rick Reeder. When you raise rates this quickly, the interest-sensitive parts of the economy, and particularly where there's financing or leverage attached to it, then that's where you create stress. Commercial real estate, he added, doesn't represent the same type of systematic risk to the economy as housing did during the 2008 financial crisis. But there are isolated pockets that can lead to contagion risk. Two early warnings of the danger that rising interest rates pose to commercial real estate came last month. Giant landlord Columbia Property Trust defaulted on $1.7 billion in floating-rate loans tied to 7 buildings in New York, San Francisco, Boston, and Jersey City, New Jersey. That followed a default by giant money manager Brookfield Asset Management on more than $750 million in debt backing 252-story towers in Los Angeles. Forced sales of more trophy buildings at large discounts are expected in the coming years as owners struggle to refinance at affordable rates. Banks were already squeezing terms on commercial real estate loans before this month's chaos. According to the Federal Reserve's latest Senior Loan Officer Opinion Survey, nearly 60% of banks reported tighter lending standards in January for non-residential and multifamily property loans. Bank lending standards had already tightened significantly over the last few quarters to levels previously unseen outside of recessions, presumably because many bank risk divisions shared the recession fears that have been widespread in financial markets, according to a note last week from Goldman Sachs. More tightening of lending standards expected as a result of new bank stresses could slow economic growth this year, Goldman said. Fed Chair Jerome Powell agreed with that view at a Wednesday press conference following the announcement of another rate hike. He said he also anticipates a tightening of credit conditions as banks pull back, which will help cool the economy. We're thinking about that as effectively doing the same things that rate hikes do, he said. But he said regional banks with high amounts of commercial estate loans were not likely to become the next Silicon Valley Bank. We're well aware of the concentrations people have in commercial real estate, he said. The larger commercial real estate world is still absorbing the shock of the Fed's aggressive campaign, according to Marcus & Millichap CEO Hessam Nadji. The effects may not pose a systemic risk, he added, but they will add to the industry's many challenges. Commercial real estate has been through a pandemic, very rapid recovery, then massive tightening of financial conditions unlike anything we've seen in modern history, he told Yahoo Finance Thursday. The last 3 years have moved the industry through a significant roller coaster. And, if you follow this channel, you know about the trouble at Blackstone and Starwood. The Blackstone and Starwood real estate investment funds are what are known as REITs. For those of you not familiar, a REIT is an investment fund that invests in real estate. REIT is an acronym for Real Estate Investment Trust. It could be structured as a mutual fund, almost like a stock mutual fund. Or, it could be set up as an exchange-traded fund, or ETF. If it is an ETF, then shares in the fund are traded whenever the stock market is open. That means that any investor could sell out whenever the stock market is open. Investors in the fund are furious. That is because many of them are now trying to get their money out of the REIT. Real estate values have fallen across the nation. And macroeconomic factors are weakening overall. If you follow this channel, you already know that the Federal Reserve is aggressively raising interest rates. And the rising interest rate environment is sending real estate values into decline. The real estate market has been hit hard, especially commercial real estate. If you follow this channel, you already know that real estate prices are falling across the United States. Institutional investors snapped up properties during a stimulus-fueled frenzy. But now, rising interest rates have shifted the sands. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.